Long call option. When would you use a long option? Well, when you're very bullish. The more bullish you are, the further out of the money or the higher strike price you can buy. Now, no other position can give you as much leverage with unlimited profit potential and limited downside risk. And in this case, you can actually control your leverage, which is the amount of money you're paying for the option as to how much commodity you're controlling by going further out of the money. However, the further out of the money you go, you have to realize this, the less likely that option is going to, the less likely the odds of that option returning a profit. Now, you would use this when you desire to profit from a rising market and maintain limited risk. The break-even at expiration is equal to the strike price plus the premium paid, as well as costs, commission costs. For each point the market goes above the break-even, your profit will increase by 1 point, the same as a futures contract. Now, the risk, well, buying options, being long an option does have limited risk. Your losses are limited to the amount you paid for the option plus commission and fees. Your maximum loss is realized if the market is below your strike price come option expiration. Okay, here we're looking at the May soybean market. And based on your analysis, you feel that the market is pretty much bottoming out. Let's say you're looking at a seasonal tendency for the market to bottom out in February and go higher into May. So you say to yourself, okay, but it isn't a downtrend, so I want to get in there and not have the same risk exposure as a futures contract. So you decide to go out and buy a call option, and you decide on the 520 call for 13 cents. You buy the option the next day, and you actually get, with the market down, you get filled at a lower price. You only pay 11.4, 11.5 cents. Now, how you calculate your break even or your, where you need the market to be for you to turn a profit come option expiration, which is the purple line, is you take the premium you paid, 11.5 cents, add it onto your strike price, and you'll get 531.5. Now, this does not include commissions, and of course, the more commission you pay, the higher, the further away your break even will be. This commission, we're going to base the commission here on $50, so you figure the market would have to go to 12.5 cents or 1 penny more to break even. That would give you 532.5 cent intrinsic break even. Now, come option expiration, if the market's at 532.5, you'll get back the entire amount you paid. However, if it's below 520, your risk is limited to that amount. So you have limited risk, unlimited profit potential. Anything above this white line will be pure profit. 28 days later, well, things worked out. And you took a $575 plus $50 commission trade and turned it into $5,531. Let it play out to expiration, and going into option expiration, you end up making $5,650. This is a call option, a long call option. It's probably one of the most popular, well, not just a call, but being long options, whether it's a put or call, is one of the more popular option plays out there.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and training techniques by industry leaders. This should not be considered as a solicitation to buy, sell, or invest in securities, options, futures, or Forex. Remember, trading does involve the risk of loss. Past performance is not indicative of future results. Stocks, futures, options, and Forex trading is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.